Hey YouTube family, and welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about the equity trap. While sellers are having a hard time selling their house because they don't want to deal with higher interest rates, that's having an impact on housing inventory and is exacerbating the whole buy and sell component of the housing market. So welcome to another edition of my show. I am your host, Kevin Strong. If you're new to my channel, please hit that subscribe button, comment, and share, because I care. So without further ado, we're going to jump right into this presentation I have for you guys here. It's called the equity trap. So we're going to talk about some really good information. I hope you are enjoying this content. Like I said, if you have not subscribed, please do so and like so YouTube shares my content. So here's some discussion points I would like to discuss with you guys. 83% of U.S. homeowners with mortgages have a mortgage rate under 5%. 83%. So for those of you who are in the mortgage industry that primarily get their income from doing refinance, it's going to be a tough road to go for quite some time. Homeowners may be incentivized to stay put by selling their home and buying another could mean giving up their ultra low mortgage rate and increasing their monthly housing bill. This is a real phenomenon that a lot of sellers are contemplating, because not only are they looking at a payment shock, a lot of homeowners can't afford the existing home that they're trying to sell when you factor in how much has gone up in appreciation in the last 3 to 5 years. Property taxes, homeowners insurance, and mortgage rates are significantly higher now than maybe when they got their house a few years back. According to Redfin economists, they're watching closely to see whether the rise in mortgage rates has a measurable impact on the housing supply. I think that goes without saying. And a lack of affordable housing is a key reason for low housing inventory. That is actually the result of, as we're talking about the equity trap, sellers aren't putting a lot of their homes on the market because, as I said earlier, they just don't want to deal with much higher interest rates. And quite frankly, the affordability crisis ties directly into that. 3 reasons why they won't sell. So there's something, believe it or not, that's called the repair dilemma. If the sellers are truly cash poor and can't make repairs, explain to them that they'll need to compensate for that with a list price that reflects the need for said work. Full disclosure, I am a licensed real estate broker in the state of Washington, and I am a licensed mortgage loan officer in the state of Washington and a couple other states I don't know off the top of my head. So why is this important? Because credit card debt is at an all-time high. People getting ready to pay back student loans. That's going to have an impact. That's for another video. And food prices, energy prices are on the rise, and they continue to go on the rise. So the average budget is just being squeezed. So a lot of these homeowners are somewhat delusional because they saw what their neighbors sold their house for in 2022, and they think, hell, I don't need to do any repairs. People are going to make multiple offers on my property. They're going to waive financing. They're going to waive the home inspection. And that's just not the housing environment we're in right now. So for some of those folks who need to get a grip with reality, it's going to take them a while to get to that point. And as a result, they're probably going to end up selling their house for a lot less than what they could have. The fear of being a buyer in this market, and that's exactly what I was talking about in the previous slide. It may be a hot seller's market, but potential sellers understand that a market that is hot for one group of people, it's the pits for the other. You got a low rate, but all of a sudden when you become the prospective buyer, now you're looking at the same issues that your buyer is. And that's that constant pull and push with the whole housing market. Rate concerns, if they go higher than 3.9%, which is where we're at, that just exacerbates the whole thing. People have got this in their mindset now that they just want low rates. I don't see rates getting down quite below 4%. Potentially 2025, notwithstanding a black swan event, no pun intended. And the most eager sellers, believe it or not, ladies and gentlemen, have already sold. I'm going to show you a graph that speaks to that statement and gets your feedback. So please, if you have a comment on this topic, I'll love to hear what you have to say, and I promise to comment on it. So here's that chart where I'm kind of indicating that the majority of people who wanted to sell their house have done so. This chart displays existing home sales basically from 2000 17 to 2022, as you can see here to the right of me, existing home sales are the clearest proxy for tracking the rate at which owners are selling their homes, in my humble opinion. And you can see that window. We rocketed right out of 2020, right during the healthcare crisis. And basically from 2020 to 2022 is really took off. And now, as you can see, it's starting to decline. And I think that decline will continue. So unless you're dealing with people who are forced to sell because of, let's say, unfortunately, somebody passing, a divorce where it's mandated by the divorce decree that you sell the house and split the proceeds and things like that, or unemployment. So what are some possible solutions for this? The first one is a negative one. It's positive for the housing market, but it's negative for you if that first statement impacts you. And that's unemployment rate has to go up, and it has to go up substantially. The wild card in all this is the retired baby boomers. So you've got a lot of people, I think almost 10,000 people a day or every other week or something like that. I don't remember the exact stat. It might be 10,000 a week or 10,000 a day are retiring. So traditionally, you're downgrading. But if a lot of those folks have their home paid off, which I think about 25 to 30% of the mortgage, 25 to 30% of homeowners in the United States don't have a mortgage, right? Then you're going to take that equity, and hopefully the prudent thing you're going to do, if you're going to downgrade to something where you don't have a mortgage you can pay cash for. But because baby boomers have been so bad at saving for retirement, a lot of them rely on their main source of retirement is Social Security, which obviously doesn't keep up with inflation. So even if you don't have a mortgage, you can find yourself in a very precarious situation financially as you get older on a fixed income, because you're going to still have to deal with property taxes, homeowners insurance, repairs, and all these other expenses that can eat away at a fixed income over a period of time. One solution that's gaining a little bit of steam here, not in aggregate, but in certain markets, is that builders are starting to reduce the size of the homes that they're building and the material costs. And this is allowing them to basically price homes at a cheaper price point because they're a smaller house, smaller materials. However, even with that in mind, it's still going to take quite some time in most markets like Seattle, San Francisco, Austin, Texas, and markets like that just went up crazy in the last 2 years. I think those markets going to take maybe till 2025 to kind of stabilize a little bit. And the reason why I'm saying that is because you need household income to be somewhat in line with the price of a home. That ratio historically, especially in a big metro market like Seattle, is like a 3-to-1 ratio. So if you had a household income of 100,000, you could afford a 300,000, maybe a 400,000. Maybe I push that up to a 4-to-1 ratio, but we're at probably a 6 to 7-to-1 ratio now in the Seattle market. So until that household income comes in line with the price of homes, I think the supply and demand dynamics of the housing market in the Seattle area are going to continue to pull home prices down for the immediate future. So as promised, I kind of wanted to keep this video a little bit shorter than normal. So I hope you guys got this video or found this video in a good place. I want to leave you with a couple other things here. If you're chasing yield, and what I mean by chasing yield is that there's some online banking institutions right now that are offering some very attractive yields, like a CD for 5%. Be careful of doing that, folks, because that could be a bait and switch. And what I mean by that is that online financial institution might have a serious problem because they're experiencing so many people withdrawing their money out of their financial institution. So their reserves are being stressed. So they're offering you a high yield to suck your money in there to boost up their reserve situation. But as a result, that bank may ultimately go down in flames. So if you're trying to secure like a 5% CD or something like that, which I don't think is keeping up with inflation, even though the government's saying, hey, we're at 4.9% year over year core inflation. I think core inflation is around 10 to 12%. This is not financial advice, but what I do is that when I'm looking for a 5 or 4% yield, I go to treasurydirect.gov and buy a T-bill directly from the United States government. That's the safest route for me. So please do your own due diligence. And finally, I'm sure some of you have heard something about a yield curve inversion, which is a indicator that we're going to go into recession. The only time that wasn't the case was, I think, in 1965 when the gross domestic product was at 10 and it went down to like 0.2, which is like 1/5 of 1%. So technically you can say that was the one time in history where when the yield curve inverted, we didn't go into recession, technically. But for all practical purposes, hell, if your gross domestic product shrinks by that amount, you're into a recession. It's like coming out of the shower. It don't look like it used to before you got out of the shower. You know, I got to go in a video without making a joke. So keep that in mind. So the range after something inverts in terms of when does a recession happen, it's a very, very broad spectrum. It's anywhere from 6 to 24 months. So who knows? But please be careful. I'm going to leave you with my famous quote: keep your credit score up and your debt down. Please do me the honor of smashing that like button so YouTube will share my content. Hit that notification button so you get notified when I do release my videos, because I do them consistently on a weekly basis. This was the Kevin Strong Show. I hope you enjoyed this video, and I hope to see you in my next one. Take care.